Hello everyone and welcome back to another exciting session on IFRS 18, Presentation and Disclosure in Financial Statement. In this session, my friends, we will cover the following key areas. Number 1, objective of financial statements. That is, what's the real goal behind preparing these financial statements. Number 2, complete set of financial statements. That is, what exactly should be included in a complete set of financial statements. Number 3, new rules of financial statements. Number 4, frequency of reporting, consistency, and comparatives. And finally, we will also discuss about the third statement of financial position. That is, when and why do we need to present this extra statement. We will be covering this content part by part. So sit back, stay focused, and let's begin with the objective of financial statements. The objective of financial statement is not just to dump numbers onto a piece of paper. It is to provide useful financial information about the company's assets, liability, equity, income and expenses so that users can assess the company's future cash flows and evaluate how well the management has managed the company's economic resources. So whether it is an investor trying to decide if they should buy your shares or bank wondering if they should give you a loan, they need clear, relevant and faithfully represent financial information. And my friends, that's exactly what financial statements aim to deliver. It's like this. If you are ordering something online, the financial statements are the product description. If the description is vague, confusing, or missing key details, you are not going to trust it. Same logic applies here. Are we clear on the purpose? Good. Okay, now let's talk about what a complete set of financial statements look like. IFRS 18 has a general requirement that tells us that what should be included in the complete set of financial statements. The complete set consists of 5 components: statement of financial performance, statement of financial position, statement of changes in equity, statement of cash flows, and notes to the financial statement. The first component is the statement of financial performance, also known as income statement. This statement shows your revenue, expenses, and profit and loss for the period. Here, you have 2 options on how to present it. The first option is to present everything in a single statement with 2 sections, one for profit and loss and one for other comprehensive income. And the second option is to present 2 separate statements, one for profit and loss and other one for total comprehensive income started with the profit and loss line, followed by all the items of other comprehensive income. The choice is yours. The key thing is that you are consistent and it clearly communicates the company's performance over the period. The second component is the statement of financial position. Yes, my friends, the balance sheet of the business. This shows your assets, liabilities, and equity at a specific point in time. The third component is the statement of changes in equity. This shows how your equity has moved up or down during the year. It captures share issue, dividends, retained earnings, and all those equity roller coasters. The fourth component is the statement of cash flows. This one comes from IAS 7, not IFRS 18, but it's still part of the complete set of financial statements. It tells the story of how cash flowed in and out of your business through operating, investing, and financing activities. And the final component is the notes to the financial statements. They provide the explanation, accounting policies, and breakdowns that support the first 4 components of the financials. Without them, you would be lost in a sea of numbers with no map. My friends, the first 4 statements, performance, position, changes in equity, and cash flows, are often called the primary financial statements. They are your main players. They form the core of your financial reporting. And the fifth component, that is the notes, they provide additional details to explain the numbers in the primary financial statements. Think of them as your backup singers that provide context to the financial story. Now, when we talk about these statements, they are all prepared for the reporting period, telling us a story of what happened during the period. It could be a year, quarter, or other period. But wait, there is one statement that's little different. The statement of financial position, that is our balance sheet. This one statement is prepared at the end of the reporting period. It's like a snapshot or a photograph of the company's financial position at a specific point in time. Here is a quick example. Think of your bank balance. At any given moment, you can check your bank app and it shows you exactly how much money you have in your bank account. That's similar to what the statement of financial position, that is balance sheet, does. It gives you a snapshot of what the company owns and owes to at a specific moment. My friend, here is something very friendly in IFRS 18. That is the naming. Naming is flexible. You don't have to call it the statement of financial position. You can still say balance sheet. Similarly, instead of statement of profit and loss, you can call it income statement as long as the meaning is clear and faithful to the content. So yes, IFRS 18 is not trying to be bossy about labels. It just wants your users to understand what they are reading, and that's fair enough, right? Alright my friends, so far we have discussed what makes up a complete set of financial statement. Now it's time to ask, why do we even have all these statements? What role do they play in helping users understand what's going on in the business? Let's dive into it. As I already mentioned, IFRS 18 split financial statement into two big categories, each one with its own job description. One is primary financial statement and second is notes to the financial statements. And together they create the complete set of financial statements. Primary financial statements are the tabular structured summaries of your company's performance and position. You already know them. Statement of financial position, statement of financial performance, statement of changes in equity, and statement of cash flows. Think of these as the main actors in a movie. They are on the posters. Everyone notices them first. Here is an important point to remember. The role of the primary financial statement is to provide structured summaries of the entity's assets, liabilities, equity, income, expenses, and cash flows. Think of them like the overview of the company's financial health. It's like checking your exam results summary, pass or fail, total marks, that kind of stuff. But if you want to know how you performed in each subject, you go to the details, right? And that brings us to the notes to the financial statements. These are the detailed explanation that complement the primary financial statements. They provide breakdowns of the data in their tables and textual description to make things clearer. My friend, don't you dare to think the notes are any less important. Yes, they are usually at the back, but they are like the detailed commentary. They explain everything that happened in the financial performance. The note provides material information needed to understand what's in the primary statement and add extra detail that could not fit in the summary. But wait, what do we mean by material information? Let me be very clear. Material here does not mean material as in raw material or inventory. It means information that is significant enough to influence decisions. So if there is something in your financials that could affect the decision of an investor or lender, it's material. No need to disclose everything. IFRS 18 even says you don't have to follow a requirement if the information is not material. Are we clear on that, my friends? Good. Let's do a quicker comparison between the primary financial statements and the notes. Well, While the primary financial statements are more prominent, they take the central stage, you could say. The notes are just as important, even though they are usually more detailed. In the primary financial statements, you present more aggregated information. Think of this like summarizing key points. But in the notes, you provide the detailed and disaggregated information that explains the numbers and data presented in the primary financial statements. So both of these categories of the financial statements are essential. One shows the movie trailer and the other is the full movie script. Alright my friends, now pay attention to this part because it is all about presentation hygiene. IFRS 18 wants you to clearly label and identify each statement and note in your financial statement. Here is what must be stated clearly on every statement. Number 1, name of the entity. Number 2, whether it is a single entity or a group of entities. Whether you are showing financials of a parent company only or the consolidated financial statements. Number 3, the reporting date and the reporting period. That is the date of the end of the reporting period and the period covered by the financial statement. Number 4, presentation currency. Are these numbers in US dollars, Pak rupee or pounds? And please, no mixing because no one likes surprises in currency. And the level of rounding used in presenting numbers. Are you rounding to the nearest thousands, nearest millions or using full figures? All of this information should be attached to every single component of your financial statements. This sounds small, but it makes a huge difference to users. Imagine seeing profit is equal to 125 and wondering 125 what? Dollars, millions, rupees or peanuts. So always make it obvious and consistent. Alright my friends, it's time to move to the next part of the important general requirement of IFRS 18. That is frequency of reporting. Imagine your financial statements are your annual medical checkup. You don't skip it, right? Similarly, IFRS 18 says you must prepare and present a complete set of financial statement at least once a year. That's minimum. By doing so, everyone can track the company's performance and financial position over the course of the year. So whether your business is doing great or facing challenges, investors and stakeholders need a yearly update. Now, what if a company presents financial statements for shorter or longer period? Well, in that case, you need to disclose the reason why. Maybe you change your reporting period because your parent company uses a different year end. IFRS 18 allows you to present financial statement for a longer or a shorter period, but you must disclose two things. One is why you are using a non-standard reporting period, and the second is a clear statement that the amount presented may not be fully comparable. This ensures that user can make informed comparison and understand the context. Are we clear on that, my friends? Great. Alright, let's now talk about another important requirement for financial statements. That is consistency. It means that once you choose a way of presenting, classifying or disclosing items in your financial statement, you have to stick with it. You must keep it consistent from one reporting period to the next. In other words, we cannot just change how we show our financial statements. You need to do it in the same way as in the previous reporting period. My friends, financial statements are not your Instagram feeds. They are supposed to help users compare performance over time. For example, if you classify your expenses by nature one year, like salaries, depreciation, rent, you should not suddenly switch to classify your expenses by function the next year, like cost of sales, admin expense, etc. Now you might be wondering, what if something significant happens in the company or the business environment changes? Well, in that case, my friends, there are two exceptions to the consistency rule. One is, if the entity undergoes a significant change in its operation and presenting things the old way no longer makes sense, then you can change it. And number two, if another IFRS standard requires you to change the presentation or classification, then that's okay too. Let's say your company has changed dramatically, like launching a brand new business segment or entering an entirely new industry, and the way it was previously classifying the expenses does not fit with the new structure. Well, that would be a valid reason for the change in presentation. Alright, my friends, let's now talk about another important requirement for financial statements, that is comparative information. My friends, when a company prepares its financial statements, it does not just report the current year figures. It must also present the number from the previous years so that user can spot trends, improvements or warning signs. This is what we call comparative information. It's basically the financial version of before and after pictures. My friends, comparative information is important because it allows users to see how company has evolved over the period of time. For example, if you are looking at the company's revenue, seeing the number from the previous year lets you know whether the company is growing, shrinking, or staying the same. But here is the kicker. Comparative information is not only required for financial figures. IFRS 18 also requires you to include narrative and descriptive information from the prior period, but only if it is relevant for understanding the current period. For example, if you are discussing a legal dispute that started last year and is still ongoing, then yes, give some background from the previous year so readers understand what's going on now. So don't just compare sales and profit, also compare stories when they matter. Okay, now, sometimes your current presentation changes. Maybe you applied a new accounting policy, fixed an error, or reclassified some items in a better way. In that case, IFRS 18 says you should go back and reclassify last year data to match the new format if practicable. Why? Because users should be comparing like with like. But if it is impracticable, maybe you don't have the old data or recreating it would cost too much, then you don't have to reclassify. But in that case, you must still disclose why reclassification was not possible and what changes would have been made if you could have done it. This way, users are still informed even if you could not provide updated comparatives. Alright, my friends. Finally, here comes the last part of this lecture, the third statement of financial position. IFRS 18 says that sometimes you don't just present two balance sheets, this year and last year. You present three. Yes, a third statement of financial position is required when you apply an accounting policy retrospectively, or you make a retrospective restatement like correcting an error, or you classify items and these changes are material or significant enough to have material effect on the financial statements. Let's say your current year is 31st December 2006 and you applied a new policy retrospectively this year. Here is what your financial statement should show in such a case. Current year, statement of financial position as at 31st December 2006. Prior year, comparative statement of financial position as at 31st December 2005. And beginning of the prior year, third statement of financial position as at 1st January 2005. This third statement is necessary because when you restate or reclassify, it provides a clear picture of the financial position from the very start of the preceding period. This ensures that user can see the effect of those changes from the beginning, not just the end. One more important point to note here is IFRS 18 says that when you are reporting to present this third balance sheet, you don't need to provide the notes for it. Just the balance sheet figures are fine. But you still need to disclose clearly what change happened, why it was made, and how it affects the financials. And if you have already applied IAS 8 for accounting policy or error correction, make sure you follow its disclosure requirements too. Alright, my friends, let's summarize everything we have covered in this mighty lecture on general requirements under IFRS 18. A complete set of financial statements includes the 5 big components. Each component must be clearly identified with proper labels, dates, currency, and rounding. Primary financial statements and notes play a different role, but they are equally important. Financials must be presented at least annually. If it's for shorter or longer period, disclose why and warn user about the comparability. Consistency is a key. Unless a significant operational change demands it or another IFRS standard requires it. Comparative information must always be provided, both numerical and narrative. And a third statement of financial position is required when retrospective changes are material. My friends, I hope this lecture gave you a complete picture of how financial statements should be structured, presented, and maintained over time under IFRS 18. Remember, clarity and comparability are the heart of good financial reporting. We don't just report the numbers, we tell the story. And IFRS 18 ensures that story is told in the right format with full context and in a faithful manner. Are we clear on that? Excellent. Alright, see you in the next lecture. Thank you.